Okay, so Doximity's fiscal Q2 earnings for 2026 just dropped. And we've got this wild situation.
Right. The company absolutely crushed expectations, raised their full-year outlook.
And yet the stock tanks, down about, what, 14%?
Yeah, roughly 14%. It's just a stark contrast, isn't it? You've got amazing operational performance hitting this wall of, well, external worry.
So that's our job today, right? Let's unpack the numbers because they were fantastic, and then really dig into why the market got spooked by this policy talk.
Exactly. Get into the great results first, then tackle that uncertainty head on.
Okay, let's do it. The Q2 results ending September 30th. I mean, these weren't just good, they were a really significant beat.
Oh, absolutely. Let's run through the key figures. Adjusted EPS, $0.45. That's up 50% year over year.
50%. Wow. And that beat estimates by 7 cents.
7 cents, yeah. Consensus was $0.38. And revenue came in at $168.5 million.
Which is a 23% increase year over year. And beat the street by nearly, what, 11 million bucks?
Almost $11 million over consensus. So, yeah, top and bottom line, very strong performance.
But you know what really stands out to me beyond the growth is the profitability. That's where Doximity often shines.
It really does. And this quarter was no exception. Their adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization,
Right.
climbed to $100.8 million. That's up 32% from last year.
Okay, 32% growth in EBITDA is solid, but the margin, that's the number that jumps out.
It is. The adjusted EBITDA margin hit 60%.
60. Wow. Up from 56% last year. So they're actually getting more profitable as they grow.
Exactly. It shows incredible operating leverage. I mean, think about that. 60 cents of every revenue dollar is effectively operating cash before those other items.
For context, what's considered like a good margin in software?
No, hitting 30% is usually seen as really healthy. So
Yeah.
60%. That suggests they have a very strong position, very efficient model.
And the free cash flow reflects that too.
Yep. Free cash flow, the actual cash generated, was $91.6 million, up 37% year over year. So by pretty much any measure of how the business is running right now,
It looks fantastic, pristine even.
precisely, which brings us right back to that contradiction.
Right. These amazing numbers, they raise guidance for the full year, and the stock drops 14%. The market's always looking ahead, so it has to be the guidance, right?
Right.
But where exactly was the problem if they raised the outlook?
It's subtle. They did raise the full year FY2026 targets.
Yeah.
Revenue midpoint now $643 million. Adjusted EBITDA midpoint $354 million. Both up.
Okay.
The issue, or what the market perceived as the issue, was in the implied numbers for Q4. Management used some cautious language around that period.
And that caution is linked to?
Policy uncertainty. That's the headwind everyone jumped on.
Okay, let's define this uncertainty. What kind of policy changes are we talking about here? Is it something specific they mentioned?
They didn't name specific legislation, which adds to the anxiety, I think. But the CFO, Anna Bryson, said, and I'm quoting roughly here, that client discussions suggest some uncertainty over how recent policy changes may influence annual budgets,
Okay.
which are expected to be finalized over the next 2 months. So their big pharma clients are basically pausing or being cautious about locking in next year's spending because of potential DC shifts.
Right, things like drug pricing rules, Medicare changes, PBM regulations. Anything that could hit pharma's own bottom line could make them pull back on marketing spend, even on effective platforms like Doximity.
That seems to be the fear. If your own revenue might take a hit next year because of some new regulation, you tighten the belt, and marketing is often one of the first places. Doximity is just reflecting that caution they're hearing from clients in their Q4 implied numbers.
Okay, so that explains the caution, the headwind. But you mentioned there was another layer to the guidance, something that actually explains why Q2 was so strong.
Yes, exactly. And this part is actually really positive, driven by their newer AI products. The strength in Q2 and the outlook for Q3 is largely because clients are adopting these new integrated AI-optimized programs much faster than expected.
How much faster?
These programs made up over 40% of their bookings in Q2.
40%? Wow. Compared to what, last year?
Less than 5% last year. So that's a massive shift in adoption in just 12 months.
Okay, 40% adoption is huge. So how does that change the guidance or the revenue pattern?
It smooths things out. These newer AI-driven programs tend to get launched earlier in the calendar year, often around January.
Ah.
Good clients see the results sooner. They're not waiting until the end of the fiscal year to make one huge huge budget decision.
Right.
Instead, they're evaluating and committing more consistently throughout the year.
So it's less about a slowdown and more about revenue being recognized earlier in the year, a timing shift.
Precisely. Management basically said Q2 was stronger than usual because of this, but as a result, they do not expect as large of a step up between Q2 and Q3 as we've seen in prior years.
Got it. So the big Q3 jump people might have expected isn't there because some of that strength already showed up in Q2. That's actually a sign of, like, healthier, more consistent buying, isn't it?
It really is. It suggests the products are more integrated into client workflows, leading to steadier spending. But, the market sometimes reacts negatively to any change in pattern, even a positive one.
Especially when combined with that policy uncertainty fog. Okay, so let's talk about the engine behind the shift and the AI itself. What are the specifics showing this adoption is real and driving value?
Well, the overall network engagement is still growing. They hit a new high, 650,000 unique prescribers using their tools in Q2.
Okay.
But the real acceleration is in the AI tools specifically, things like AI Scribe and DoxGPT. The number of quarterly active prescribers using those tools jumped more than 50% just from Q1 to Q2.
50% quarter-over-quarter growth in active AI users. That's rapid adoption.
It is. It shows doctors are finding real utility.
Let's break down AI Scribe first. That's the ambient note-taking tool, right? IPA compliant.
Yeah, and it's integrated right into Doximity Dialer, their telehealth platform, which is already huge, used for like 300,000 calls or video visits every weekday.
And you said active Scribe users nearly tripled from Q1.
Nearly tripled. The value proposition is just so clear. Less time on paperwork, more time on patients, or just getting home earlier.
They had that anecdote, didn't they, about the doctor finishing notes quickly?
They did. A family medicine doctor said something like, I saw 22 patients today till 5 p.m. and was out of the office by 5:15.
15 minutes to do notes for 22 patients, that's transformative. You can see why doctors would adopt that.
Absolutely. That kind of time saving creates immense stickiness. It makes the platform indispensable.
Okay, so that's Scribe. What about DoxGPT, the clinical reference tool?
Okay.
How is that differentiating itself from, say, just using a general AI?
Trust and specific integrations are key. They've layered it on top of Pathway's medical data set, and they highlighted two big advantages. First, it's got a fully integrated drug reference, meaning a doctor can ask about dosing, interactions, whatever, and get an instant peer-reviewed answer grounded in reliable medical data. Less risk of the AI just making something up, which is critical in medicine.
Makes sense. And the second advantage, something about journal access.
Yeah, this is pretty cool. Through a partnership with Research Solutions, they offer direct, full-text PDF access to over 2,000 medical journals right within the platform.
So you ask a question, get the DoxGPT summary, and then you can click right through to the original research paper without hitting a paywall.
Exactly. For clinicians and researchers, that seamless link between AI summary and the primary source is a really big deal. Saves a ton of time and hassle.
You can see how that utility drives the engagement numbers we talked about. Now, just quickly, how do the sort of legacy business metrics look? Is the core business still healthy underneath this AI surge?
Oh yeah, the foundation is still incredibly strong. Net revenue retention rate, basically how much existing customers increase their spending year over year, is still very high at 118% on a trailing 12-month basis.
So existing clients are spending 18% more on average than they did the year before. That's solid expansion.
Very solid.
Right.
And they're also growing their base of large customers. They now have 121 clients spending at least $500,000 annually.
Up 16% year over year?
Yep. 16% growth in those top-tier customers. And crucially, those 121 clients make up 84% of their total revenue.
So the biggest players, the ones most likely adopting these integrated AI programs, are sticking around and spending more.
Exactly. It shows commitment, even amidst the broader budget uncertainty we discussed.
Okay, so wrapping this up for the listener, it really feels like two different stories happening at once, doesn't it?
It does. You've got story A, amazing execution, huge profitability, rapid AI adoption that's actually improving the business model and revenue flow.
Right. Phenomenal operational success. And then story B. This cloud of external policy worry making big customers hesitant about future budgets, which overshadows everything else in the market's eyes right now.
Perfectly put. And it's worth noting, Doximity isn't backing down on the AI front because of this. They specifically said they'll keep investing heavily in AI development through the rest of the fiscal year.
Which signals their confidence that the AI value will ultimately win out. And they plan to do that while still keeping margins incredibly high, guiding to 55% plus adjusted EBITDA for the full year.
Yeah, maintaining that level of profitability while investing aggressively is quite a statement.
So here's the thing to watch, right? We've seen Doximity use AI to change how clients spend and how doctors work, saving them huge amounts of time. The real question over the next few months, as these budgets get finalized, is whether that value, that efficiency and stickiness for doctors is strong enough to make Doximity essential spending for pharma, even if those broader policy pressures do tighten budgets.
That's the litmus test, isn't it? Can the platform's utility insulate it from external budget cuts? Is it now a must-have, not just a nice-to-have?
That's what we'll be watching for. The resilience test is happening now.
And we'll get the next official update soon enough. The Q3 earnings report is expected around February 5th, 2026.